Okay, so let's talk about the housing market. A lot of activity going on there over the past few months. Here's a quick rundown of some of the facts. 42% of homes are selling for over their list price as of the start of April. Nearly 75% of the 100 largest U.S. housing markets saw annual home price growth of 10% or higher. The median selling price for existing homes leaped 17.2% as of mid-April from the same period a year ago to a record high of over $329,000, according to the National Association of Realtors. Homes are getting multiple offers, which is bidding up prices. You also have some homes that are going on the market and selling within days or less of being put up on the market. So what is causing this huge boom in demand? Well, particularly all the stimulus that came as a result of COVID, namely the credit expansion from the Federal Reserve, is lowering the price of loans, and that is spread into the mortgage market. And we can see mortgage rates fell steadily from this time last year. They rose again briefly in March, but now they're below 3% again. So that's what's going on the demand side. But on the supply side, you also have some factors that are bidding up the price of homes. Namely, the supply of homes is down. There's only half as many listed for sale as there was a year ago. There's also a lumber shortage, which is adding about $24,000 to new home costs, according to the National Association of Home Builders. But home builders are beginning to increase production, and housing starts climbed 20% in March to their highest level since 2006. Now, if this all sounds a bit familiar, you're not alone. Google reported in early April that the search term, "when is the housing market going to crash?" had spiked 2,450% over the past month. So it's good to see consumers catching on to some macro trends here and remember the causes of last recessions, particularly the housing bubble. But there is a pretty big indicator that if this is a bubble, it wouldn't be nearly as severe as the 2008 bubble that led to the recession. Namely, lending standards are much higher. You're not having people qualify for mortgages that really cannot afford them like you were in 2008 or leading up to 2008, where people didn't even have to declare their income to qualify for a mortgage. And when their monthly mortgage bill came, they couldn't afford it. So you had a lot of foreclosures and people lost a lot of money, which was a huge catalyst for the recession. But lending standards now much higher. Most of the people getting mortgages can probably afford them, so you wouldn't have that risk. However, we're not out of the woods for a bubble. Whenever you have manipulation of interest rates, such as is done by the Federal Reserve, and you lower the price of credit, that causes and spurs an excess demand for credit, and in this case, excess demand for homes. And we see that the home builders are accommodating this excess demand by building more homes, and that uses scarce resources such as labor and materials into building homes, and which are long-term projects. Which means they're not building other things that would have been built absent of interest rate manipulation. And that has a problem in the sense that we're coming out of a recession here, and you want to make sure that resources are allocated to where they're most highly valued. And if you have manipulation of interest rates, you're kind of tying up a lot of resources, and like I said, in labor into one industry, but that's coming at the expense of others. Which is, of course, this is termed resource misallocation, and this is a major cause of recession. So that certainly appears to be going on. But let me know your thoughts. Is this a bubble? Is it not? I'm sure I may have missed something. Applying economics is very complicated. There's a lot of moving parts. So let me know what you think at jamestalaka@economytv.info. Love to hear from you. All right, see you next time.